US-China trade war escalates. The US-China trade war has gone up a notch with the announcement from Washington that it will go ahead with the imposition of a 25% tariff on $16 billion worth of Chinese goods from August 23, to which Beijing has declared it will respond in kind. This is the final tranche of tariffs on $50 billion of Chinese goods that the Trump administration decided to impose in July, invoking Section 301 of the 1974 Trade Act. As Beijing has matched Washington's tariffs, $100 billion worth of trade between the U.S. and China will now be subject to the tariff hike. The U.S. trade war measures are set to escalate. The administration has threatened to impose tariffs on another $200 billion of Chinese products, possibly by the beginning of September, following public hearings on the proposed measures later this month. The initial threat was a 10% levy, but Trump has since directed U.S. Trade Representative Robert Lighthizer to investigate a 25% impost. Trump has also threatened that a further $200 billion could be impacted, which would mean that virtually all Chinese imports to the U.S. would be covered. Beijing has released an additional list of $60 billion worth of U.S. products it would start taxing if the White House proceeds with the further escalation. The latest hike follows a series of tweets by Trump last weekend in which he claimed the U.S. was winning the trade war against China. He pointed to the fall in Asian stock markets, down by more than 25% so far this year, and the fall in its currency, the yuan. China responded with an editorial in the state-owned Global Times saying it was prepared for a protracted war and did not fear sacrificing its short-term economic interests. Considering the unreasonable U.S. demands, a trade war is an act that aims to crush China's economic sovereignty, trying to force China to be a U.S. economic vassal, it declared. The Chinese Commerce Ministry responded to the latest U.S. tariffs by releasing the list of goods to be targeted. In order to defend China's rightful interests and the multilateral trade system, China has to retaliate as necessary, it said. An editorial published by the official Xinhua news agency on Wednesday stated that China would get through the storm, and those imposing the tariffs would end up hurting themselves. Some people selfishly swim against the tide and act against morality, wantonly raising the barrier of tariffs and waving the stick of hegemony everywhere, it said. While informal discussions are being held, there seems little prospect of top-level negotiations to de-escalate the conflict. This is because the central demand of the U.S. administration is that China must not only reduce its trade deficit with the U.S., but must also take action to wind back its plan to develop its industrial and technological base under the Made in China 2025 program. The U.S. maintains that the Chinese plan involves the appropriation of U.S. intellectual property rights through theft and forced technology transfers. It also claims that state subsidies to Chinese firms give them an unfair advantage in global markets, especially in the key area of high-tech. As many commentators and economic historians have pointed out, the Chinese practices are a repeat of many of those used in earlier times by the U.S. and other countries, including Japan and South Korea, as they sought to develop their industrial and technological capacities. However, key anti-China hawks in the Trump administration, particularly Lighthizer and White House economic advisor Peter Navarro, insist that Chinese efforts to do the same threaten the economic and ultimately the military supremacy of the U.S. and cannot be tolerated. The view in Beijing is that the U.S. objective is not primarily the reduction of the trade deficit, but the subordination of the Chinese economy to the U.S., turning it into an economic vassal. This assessment was strengthened by the events of last May, when Chinese Vice Premier Liu He came to Washington. He reached an agreement with U.S. Treasury Secretary Steven Mnuchin to increase Chinese imports from the U.S. by as much as $100 billion and put the trade war on hold, only to have the agreement overturned by Trump within a few days. While Trump is claiming the U.S. is winning the trade war because of growing problems in the Chinese economy, the prospect of a significant downturn is striking fear among many countries in Southeast Asia that are dependent on Chinese markets. As the South China Morning Post noted in a report on August 4, if China were forced to devalue its currency, the only reaction in Southeast Asian capitals from Kuala Lumpur to Hanoi, Bangkok, and Jakarta will be panic. There are vivid memories throughout the region of the impact of the 1997-98 Asian financial crisis. Its effects were in some cases equivalent to the 1930s Great Depression in the West and could have been even worse had the Chinese currency been devalued. The outcome of the crisis was a turn by Southeast Asian nations towards the Chinese economy, on which they have become increasingly dependent. Concerns are also being raised in South Korea about another aspect of the U.S. trade war: the threat to impose tariffs on cars and auto imports on national security grounds, under Section 232 of 1962 legislation. While this tariff threat has been put on hold following talks between Trump and European Commission President Jean-Claude Juncker last month, it has not been removed. According to a Wall Street Journal article, if the tariff threat is carried through, the South Korean parliament will not ratify the US-Korea trade deal announced earlier this year. Under that agreement, the U.S. won major concessions, including allowing it to retain a 25% tariff on South Korean trucks, and an agreement to cap steel exports at 70% on their level over the past 3 years. South Korean officials have said they have not been able to get a clear commitment from the U.S. on whether their country would be excluded from any U.S. auto tariffs amid warnings that the trade deal will blow up if they go ahead. The potential global impact of the escalating U.S. trade war has been highlighted in a report issued this week by Oxford Economics before the latest measures were announced. It stated that the US-China conflict could reduce world output by 0.7% by 2020, with China's economy slowing by 1.3% and the U.S. by 1%. It said while there was not yet a major risk of damaging stagflation, rising prices, and a slowing economy, the prospect remained of a bigger blow-up that sharply reduced trade as took place in the 1930s. Chinese tariffs on U.S. gas exports may shift the global market. If implemented, China's proposed 25% tariff on U.S. LNG will cause shifts in the LNG market. China is the number 2 importer of LNG globally, while the U.S. is climbing up the ranks of major LNG exporters. China's threats of new tariffs on $60 billion worth of U.S. imports will create shifts in the energy market, as American liquefied natural gas makes the list of goods Beijing will target, analysts said. The move to include LNG raised eyebrows, as China had previously held back at including the fuel on the list of products subject to tariffs. That is, as the country looks to natural gas as part of its efforts to clean up politically sensitive air pollution. But things have changed since trade tensions with the U.S. escalated dramatically in recent weeks, and some have questioned if Beijing's move will hit American gas exports. The U.S. is the world's top producer of natural gas and is a growing major exporter of LNG. If implemented, a tariff on LNG would deal a serious blow to the U.S. gas industry and President Donald Trump's energy dominance agenda, said Hugo Brennan, senior Asia analyst at consultancy Verisk Maplecroft. Chinese gas demand forecasts are underpinning a raft of proposed LNG export terminals along America's east coast, which align with the Trump administration's bid to turn the U.S. into an energy superpower. But some of these projects will struggle to attract financing if China goes ahead and raises tariff barriers on U.S. LNG, Brennan wrote in a Tuesday note. China was the world's second largest importer of LNG last year. The country is expected to become the world's top importer of the superchilled fuel next year, the International Energy Agency said in June. Last year, about 15% of U.S. LNG exports went to China. The current standoff is a sharp shift from the situation earlier this year, when Beijing offered to buy more U.S. energy exports to reduce the massive bilateral trade deficit. Now, that looks like a distant prospect, given that high-level talks have broken down against a backdrop of threats and counter-threat, said Brennan. Still, there are analysts who counter that the U.S. gas export boom is something that cannot be stopped with or without China. Currently, most U.S. LNG exports are secured on long-term contracts, so the impact will be fairly limited until the deals expire. However, the spot LNG market, which has been growing steadily, will be hit. Longer-term contract negotiations could also be affected. Winners and losers. A 25% import tariff, amid a backdrop of strong government rhetoric against U.S. energy imports, is likely to see U.S. LNG priced out of the lucrative Chinese gas market, said analysts at Fitch Solutions Macro Research. Brennan echoed that sentiment, writing in his note that geopolitical dynamics will undermine American exporters' bid to become major gas suppliers to China. Indeed, U.S. LNG customers from China have told energy information firm Platts that companies will be deterred from ordering American supplies in the near term, as the tariffs will push prices above what they can afford. Platts cited unnamed sources at state-owned and privately held Chinese companies. Fitch Solutions said it expected major LNG players such as Shell, Total, and Trafigura to be the most affected, as they acquire cargoes from U.S.-based projects before selling them onto markets where demand and prices are the strongest. On Wednesday, official data from China showed U.S. imports of LNG fell to their lowest level in a year for the month of July, Reuters records showed. That softening came amid the backdrop of strong 2018 gains. China imported about 17% more U.S. LNG from January to July this year, and it did in all of 2017, S&P Global Platts Analytics data showed. Still, Giles Farrer, research director for global gas and LNG supply at Wood Mackenzie, said in a note last week that the U.S.-China spat was unlikely to be terminal for American suppliers because plenty of appetite exists from other buyers in Asia and Europe. Analysts are now expecting China to look toward alternative sources, with major LNG suppliers like Australia and Qatar likely benefiting from the developments in the long run. The boost to Australia could be bigger over the next 5 to 10 years, as the opportunity of grabbing a larger share of China's growing LNG market may prompt Australian producers to expand capacity and output. That could help mitigate the long-term hit to Australia from a rise in global trade barriers, research consultancy Capital Economics said in a recent note. Demand for piped gas from suppliers like Central Asia and Russia may also get a lift, experts said. China, meanwhile, could find itself more vulnerable to energy price spikes if its potential pool of LNG suppliers is reduced. Although U.S. LNG makes up a relatively small component of China's overall gas mix, seasonal spikes in household and industrial demand can drive up the need for short-term cargo purchases such as those from the U.S. to supplement long-planned volumes, said Fitch Solutions. The need for flexible cargo demand in the winter is evidenced by China importing more U.S. LNG from November 2017 to January 2018, and it did during the first 10 months of 2017, Fitch Solutions added.